Welcome all. Today we have CA Milan Rupchandani with us, who is practicing registered valuer for the asset class securities and financial assets and is registered with IBBI. He is member of Institute of Chartered Accountants, and it is very good to hear that he qualified as a CA at an early age of 21 and has post qualification experience of 6 years and pre qualification experience of 3 years. He is working in field of valuation since he qualified as chartered accountant. So under our scheme of introducing young talents, we have thought of introducing Millet to our panel. He would be mostly dealing subject related to valuation, and Milan, the participants would like to share or listen your views or views of a CA on data valuation, because as initially briefed to you, most of the participants or almost all are keen for data protection or in this particular environment of data security. So we want to or we wish to hear your views on data valuation, and how the say CA industry is looking to this particular topic, that is data. So the floor is for you. The pattern will be, initially you will be sharing your thoughts, and if you want to have questions in between, you prefer whatever way you want, but 40 minutes plus 20 for Q&A is standard pattern. So now it's Milan who will introduce his subject. Welcome, Milan.
Thank you, Mahendraji, and thank you everyone for giving me this platform, giving me this opportunity to present before you valuation of data, valuation as a discipline, how it works in case of data. So, about the mechanics, how this session will go, I'll be discussing in detail. I'll be presenting my views before you on data valuation, and in between, if anyone have any queries or if anyone have any inputs, we can discuss that. It will be very helpful. I'll be glad to take those questions, and it will be very good discussion if we have an interactive session. So I won't mind any questions coming in between or at the end of the session. So proceeding with our subject matter, data valuation. So to undertake valuation of anything, firstly one needs to ask themselves this question whether the subject matter that is being valued or that needs to be valued, does it carry any value? And before that, anyone will have question that how can something have any value, when how can someone ascertain that something has any value? So what are your thoughts on this? For anything or any substance or any property, how will you determine that if it has any value or not? Let it be data or anything else, because the concept, the principles are common. Very simply speaking, if anything has to have some value, it should have fundamental aspect to it, such as that it should either bring inflows or it should save your outflows. In economic sense, fundamentally, this is the only reason, this is the only case wherein something can have value. So for example, अगर हम लोग कोई प्रॉपर्टी बाय कर लेते हैं या लीज पे ले लेते हैं, so that property will have value because it is helping us to save our rent, it is helping us to save our cash outflows. Or in other sense, in if something we have, if we would not be having it, we would be incurring some cash outflows, or our cash inflows will get reduced or substantially affected. So fundamentally speaking, intrinsically speaking, to anything have value in it, it must bring cash inflows to you or save your cash outflows. This is the fundamental judgmental line for anything to have value. Now, applying this principle on data, if any company or any entity or any organization, if it has data, and one has to ascertain that if that data is valuable to it or not, does that generate any value to it or not, the fundamental question that the company needs to ask itself is, if I have this data, whether it creates cash inflows to me directly or not, or with by having this database information, by any term that you name it, whether I'm able to save my cash, either it can be indirect expenses or directly any big chunk of money that I need to pay. Data have one more another aspect. Let's say if I have some accounting information and I lose it, or if I have some cost sheets or some confidential details which if I lose, and that is very intrinsic to me, which is very core to me, and I need it, so I either have to procure it back again, that will result into cash outflow, or if I do not have that data, it will substantially affect my cash inflows. I'll be foregoing my cash inflows, or I will not be able to generate as much as of cash inflows that I would have been able to generate had then data been with me. So, if we apply this basic fundamental principle of generating cash inflow to anything, as our subject matter is data, if a particular data is able to generate cash inflows, anyone can consider that data as valuable. Now, generally speaking, if we see in today's modern world, in today's dynamics, whether data generally holds value or not, surprisingly, compared to an economy situation which was 10 to 15 years ago, the market pioneers, the leading corporates in the world, were the companies having being rich in natural resources, or being good in manufacturing business. Those were the market leaders. One can easily say, if we consider India as a market, that Tatas and Ambanis were leading business earners because they were the leading marketers in the field of manufacturing as well as natural resources such as oil and energy. But if you see today, the with very few exception, the market leaders are the ones which are having data under their fold. The companies such as Facebook, Google, Apple. In India, if we say uh, Flipkart, Amazon having its entire presence over the world. Currently, Reliance also finding this position that the market leaders are the one which are having hold on data, is gradually shifting its business from oil resources and energies to data business, data collaboration, database. That's why in today's date, Reliance is having its a good chunk of value out of its business, geo business, wherein it has large number of subscribers and thereby large number of data of all those entities. This is being one aspect of the companies which are directly dealing in the business of data. They are collating data, they are refining it, they are selling it to in the market, for which this refined data uh, is their secondary product, is their product basis which they can lead in the market for with their products for, let's say, advertising, manufacture, professional services, etc. But the companies which are not directly into data management business, or which are not directly into the business dealing with information and data, such as manufacturing companies, professionals, traders, construction companies, banks, whether data is valuable for them or not. One, again, to understand if the data is valuable for them, one has to apply that basic principle, whether that data can lead to cash inflow for them, or if absence of that data will result into any cash outflow for them. Taking an example, if someone has a list, if an entity, a professional person, a professional organization, let's say it has a list, or it has accumulated a list of customers, whereby it can tap those customers, can go to them, can present to them what they can do, and bring business on board. Versus if that data is not available with that professional team, with that professional organization, it can generate revenue, people can come to them by their own, or by their name, or by their work, but the revenue is affected comparatively. If that data, that information would have been there, let's call that customer list. If that customer list would have been there with profession, their revenue would have been, let's say, 50% more than what they could have earned. Then definitely that data is valuable for them. That data, they would definitely would want that this is kept with them, they use them, and that is not lead to someone else, because that data is in itself carrying value for them, because they are having a competitive edge over other entities who are not having this data, and therefore are earning or making less revenue. Similarly, for other companies or other entities whose business are not directly related to data, but are holding data such as accounting information, in manufacturing entity, the cost sheets, whereby how they are arriving at a cost of their particular product, how much margin they are offering, how much implied return they are earning from their each product, and thereby how they are capturing their sale market by just differing to a particular price. If that information is helpful for them, if that gets, let's say, corrupted, or that gets lost, naturally that data is, without that data they would be at a loss, they would not be knowing how much selling price to be quoted in the market, such that they can earn a huge volume, because price and volume are directly related. If they reduce the price, the sale volume will increase. If, just very fundamentally speaking, assuming all factors remaining the same, as an economic principle, if a price of a product is increased, they will lose the volume, so they need to mitigate that gap, that so that they are at their optimum profits. But without that data, either they will be at a loss, or they will have to reacquire that data by paying off to cyber cells, to IT professionals, so that they can regain that data. So, applying this principle of data having value to each and every industry, either any industry dealing directly, working directly in data management or data collation and selling it, such as the greats of the world currently, Facebook, which is now Metaverse, and uh, Amazon, Google, which is a huge data collating company, the main source of revenue that is generated from them. Apart from that, the other entities, the other companies, such as banks, manufacturing entities, professionals, anyone which have this information, if their revenue is getting decreased, or if their cash inflows are getting decreased with in absence of some data, then naturally data is valuable for them, data is valuable for any one of them. there can be cases that if there is some information available with them and if it is lost, then there is no loss of revenue for them, then that particular data will not have any value from economic front for that particular entity. It can be the case that that data is not valuable to a particular entity but can be valuable for another entity with which it is there. So, with this discussion, with this summarized discussion, now anyone of us can just put a point, ad hoc number or ad hoc value that a particular data has a value or not. But now, uh, if someone wants to put a number onto it, that how much valuable this data is to me or to anyone else for multiple purpose. If someone wants to sell that data, if someone wants to sell that their company, and someone is saying that look, I have this additional data or additional information which others don't have, so I want to sell my company with a higher value, then the other person would be asking how much and why. Please prove it to me that I am liable to pay to you for this additional data that you have. That ballpark number is important also. As you all are directly dealing with data protection, right? So ताला इतना महंगा नहीं होना चाहिए, इतना कीमती नहीं होना चाहिए कि जिस डेटा को प्रोटेक्ट कर रहा है उससे उसकी कीमत ज्यादा हो. So anyone wanting to avail data protection uh, security from anyone, they need to understand how much cost they should be paying, because they need to understand how much value they are protecting from it. Anyone paying 5% of the total value to protect 100% would be okay to pay a shell of that 5%. Now the idea is how to put that number on that data or on that substance. So firstly, now moving on to this valuation part, how someone can value data. Principally speaking, there are three methods to value any any asset. And since data is carrying value, it is definitely an asset. It is although not recorded in the books of accounts. It's recorded in the book, not recorded in the books of account because of the uh, regulatory requirements, the accounting principles of the world of law of the land. The general accounting principles in any geographic area, be it in India or in US or in Europe, does not allow to record those assets which are created internally and without incurring any expenses. They allow us to record those assets in the books of accounts only if it has been purchased from some third parties, or if it has been retained, or if it has been developed by incurring some expenses. So there are accounting principles. So generally speaking, if someone has some internally accrued data such as list of customers, such as uh, general research, that which area is a good area to hit our targets, or some information acquired from some source for which no money has been paid, such information is not allowed to be recognized. Such data is not required to be recognized in the books of account as a valuable asset. But for the purpose of management, for managerial purpose, one would like to know that how much value does this data have. Data as in its nature is an intangible asset, and not, and unlike a tangible asset, it cannot be specifically and regularly identified, but one would like to put a identified value thereon, so that it can demonstrate that it has some value. It has some valuable asset which they have termed as database, which carries value for XYZ reasons, and for that either they need protection or they want to sell it or they can make use of it. So to value that intangible asset, that data, or any intangible asset, there are basically three methods of valuation. One is, as you can see on the screen, income approach, another is market approach, and third is cost approach. Very frankly, I would not term market approach and cost approach as valuation methods. Frankly speaking, because the what market approach and cost approach does is, we will see in the subsequent slides, and that are not dealing with the fundamentals of valuation. So taking on one by one, let's take up income approach first. That how someone will value data under the income approach. Firstly, what is so guys, till now, does anyone have any queries?
Put in chat box. In chat box, you can see queries, or shall I read it for you?
Just a minute, I'll be going in the chat box.
So first is you are explaining, that is income approach, market and cost
Yeah, what
approach.
methods or strategies will be used to evaluate any data? Yes, I'll be onto that. I'll be taking this only in complete detail.
Yeah, yeah.
This is the basic understanding of our discussion. But to go on to that, I needed to paint a picture in your mind to understand how we will be valuing something. If
Sure,
any
go
company
ahead.
wants to acquire any other company, what its values are preferably looking, and is that approach changing now due to significance of data currently? So yeah, I believe we covered this. That see, when someone wants to sell a company, Mahendraji, very simply speaking, they will be looking at the balance sheet and will observe what all assets it has in its books of accounts. Those will be generally allowed by the generally accepted accounting principles of the land, which will allow those assets to be recognized. It can be tangible assets, it can be intangible assets. But very generally speaking, in the entire world, the internally generated assets, such as goodwill, such as database which has been accumulated, are not allowed to be recognized in the books of account as an asset until and unless someone has paid money for that, either to third party or for some R&D. But if someone is looking at the balance sheet, if there are 10 assets valuing 100 each, someone will say that it is only of 1000, the company is worth 1000. But while valuing the entire company, one will look at other methods, other internal accruals as well, such as database, such as goodwill, such as that the company standing is so long, the company's name, the reputation is so long, that one will not pay only for assets, it will also pay for the reputation. And that valuation is generally generated by valuing the entire company. If someone wants to specifically point blank ask that what is this extra value for, generally it's for goodwill. However, goodwill is a residual intangible asset. If any other intangible assets cannot be identified, but if there are specific intangible assets such as list of customers, customer relations, intellectual properties, or patents that has been internally generated, or R&D, those each and every intangible assets needs to be specifically valued. They needs to be separately valued. In our case, since we are discussing data, since we are talking about or data valuation, let's assume that that company has data in its balance sheet, not not clearly visible in the balance sheet because of the accounting principles, but the owner of the company wants to pitch that my company has this data which is valuable because of these reasons, and naturally I want to sell this company not at its book value, not at the value which my balance sheet, my financial statements are saying, but at an additional value because I have this intangible asset data which also carries some value and I want money for that. So naturally, that one person will go to a valuer and ask, I want to get this data valued so that I can put a number on it and tell others that this is his number. And if one asks, why is this number there? Why this one? Why this is the value and not anything else? I need a report which needs detailing of why, how we arrived at this valuation. So I'll be just coming on to this in a detailed manner. I was just coming on to it, but before that, coming on to last question: how about internal accruals? They are recorded in the books. Sorry, Meena ma'am, I didn't understand your questions. Could you
So
please
I will
elaborate on?
explain, Milan, I will explain the question. You see, you said as per the current accounting principles, uh, data is not allowed, is not recorded in the books of accounts, because what is recorded in the books of accounts is the asset which has been purchased on payment of some consideration, right?
Right,
But internal accruals are not something, is not something which is purchased by payment of consideration. So
right.
therefore, keen to understand that internal accruals are definitely recorded in the books, are reflected in the books.
Which
So
internal
why the data?
accruals, ma'am?
Sorry.
Could you which internal accruals? Could you please give a specific example?
So there could be. I'm not an accounts person, but I keep hearing these terminologies. So I thought it could be relevant for us to
So
understand this.
let me elaborate on that part definitely. Uh, when I said internal accruals, what I mean was, let's say
Mm-hmm.
I have a land which I
Hmm.
had purchased, let's say 10 years ago. I
Huh.
purchased it for, let's say 10 lakhs.
Hmm.
After this 10 years, that 10 lakhs has increased to 50 lakhs.
Hmm.
So
Correct.
my this is the internal accruals. This is the unrealized gains on the asset.
Correct.
My accounting principles does not allow me to recognize it in my books of accounts and thereby increase my company's value. But definitely, when I'll be selling this company, I would not be allowing someone to buy this company for, let's say, the company only has this asset of 10 lakhs.
Hmm.
I will not allow anyone to sorry, to buy this company for 10 lakhs or 12 lakhs. I'll be definitely asking for 50 lakhs because if I go and sell the land in the market, I'll get 50 lakhs.
Hmm.
Now, this was with relating to tangible assets. Let me give this example with respect to intangible asset. Now, I am running the business for 10 years. Okay. And
Hmm.
in my books of accounts during this 10 years, I have accumulated various assets, plant, buildings, goods, machineries, plants, etc., vehicles, and assume that the total value of it is 10 lakhs. If I go in the market and sell these things in a piecemeal,
Huh.
these assets will fetch me 10 lakhs.
Hmm.
But I'm not selling this piecemeal assets. I'm wanting to sell this company as a whole,
Slump sale.
right? Yes. And which is not only dependent up with whose value is not only dependent upon these piecemeal assets. My business is up and running. I
Hmm.
have customers with me who will be regularly buying my products. I
Hmm.
have customer. I have created my brand value in the market. So with that, if let's say I'm selling in the market products, I'm earning a net profit of 7 lakhs each year,
Huh.
and this is going to happen forever. Okay, this
Hmm.
7 lakh will increase to 8 lakhs in next year, 9 in third year, fourth year, it will be to 10 lakhs, and gradually it will be keep on going. I'll not be shutting my business in 5 years. Okay,
Hmm.
so if in a very plain manner, I sum up these cash flows 5, 6, 7, 8, 9, 10, 11. This will sum up to 25 lakhs. So naturally, I'll ask them, look, I am generating cash inflows of 25 lakhs from this business. Why would I sell this for 10 lakhs?
Hmm.
Instead of that, I would like to continue this company.
Hmm.
So the process of valuation, what it covers is it puts a number on that company considering this cash internal accruals of 7, 10, 25 lakhs to equate it with today's value. That is what the valuation process do. And now this incremental value which valuer has assigned to the company over and above the value which is being reflected in the books of accounts of 10 lakh, that is the intangible asset that can again be apportioned to different kind of assets. If the owner is saying that I have this data which needs to be specifically valued, that can also be done, which again I'll be coming on to. I'm holding on all those things for one side, because that is already a part of my
Okay,
session
then I
part.
think you should go ahead with your presentation, Milan. We should not
Yeah.
interrupt your thought. Please
Yes.
carry on.
So, yeah. So taking on this last question, if that is again related to that, I'll continue my session and we'll be covering these questions in that. In my view, it is subjective on the basis of the person who sees value in it. Therefore, it may be more valuable to some and less valuable, or not at all valuable to others. The balance sheet has assets that have market value regardless of who buys it. So Deepak ji, I'll cover this as well in during my session. I have covered income approach, market approach, and cost approach. You are thinking on the right direction, that market approach is a subjective valuation. In fact, entire valuation is subjective. It's an opinion and it's subject to discussion for different people, and it's about convincing each other fundamentally, the two parties, that why they are more correct and the other is not, why their assumptions implied to value the particular asset is fundamentally correct or incorrect. So now catching back on the income approach, and as I said to that, for me, very bluntly speaking, very being frank with you, for me, market approach and cost approach are not the approach to value the company or value the data or any asset. They are pricing approach. They are an approach to put a price on a particular asset, and that price that those prices are just used as a substitute of value. Those are not exactly value, and we'll come on to that why I am saying that. Under the income approach, the fundamental principle is, the implied principle is, if a particular asset, in our case data, is unable to generate cash inflows or save cash outflows, it does not carry any value. If it is able to generate cash inflows, then those cash inflows are replaced with a suitable number which represent cash inflows of future, and that is termed as value under income approach. So under the income approach, the accruals, the inflows that are being generated by data over the period of its life, over the period of time, and those cash accruals, one represented by its present value, is termed as valuation under income approach. अगर एक एग्जांपल लिया जाए, लेट्स से कि मेरे पास एक डेटा है, कस्टमर बेस, कस्टमर लिस्ट, जिससे मैं कैश इन मुझे एक्स्ट्रा कैश इनफ्लोज हो सकते हैं जो मुझे नहीं होते थे अगर मेरे पास वो डेटा नहीं होता था। तो उस स्पेसिफिक पर्पस से या उस डेटा के कारण जो मुझे कैश इनफ्लोस आ रहे हैं, उनका आज की वैल्यू कितनी है, आज की वैल्यू की टोटल को उसे वैल्यूएशन कहा जाता है, उसे वैल्यूएशन अंडर इनकम अप्रोच कहा जाता है। टू टेक एन एग्जांपल, लेट्स से मैंने थोड़ी देर पहले भी एक एग्जांपल लिया था, लेट्स से आई हैव अ बिजनेस विथ व्हिच ईच ईयर आई एम एबल टू generate cash inflow of 10 lakhs with some let's say I have purchased some database, and that database is helping me to market my product more, and to with that more additional marketing, I am able to increase my revenue and increase my cash inflows, let's say by 2 lakhs per year. So my revised cash inflows is 12 lakhs. So this additional 2 lakhs per annum is generating value of that particular data for me. In this scenario, we assume that we purchase some data assuming we have some internal data which is leading into this additional generation of cash, that additional generation of cash is representing value for that data. Now, a simple concept है. If I say कि if I make this deal with you guys कि you give me 10 lakhs to me today, I'll return that 10 lakh to you after 1 year. Will you be okay with that deal? Any inputs, any answers?
No.
No.
No, right? Why?
So there is nothing earned on it. So
Sorry?
I didn't get anything additional in return.
Right. So you are expecting that if you are giving me 10 lakhs today, you are expecting some additional return onto it. Why? Just because it has been kept for a year, and after that, if it is better if I'm not getting anything else, why should I give it to you, right? So this is a principle. This is a principle of time value of money, that money has time value. If money is kept for particular time, then for that time that money or the owner of that money will expect some value out of it. Simply speaking, if assuming that the current interest rates in the banks are 5%, if current to this compared to this deal, you give me 10 lakhs today and I'll give you 10 lakhs back after 1 year. You put that 10 lakhs into bank. After 1 year, bank will return you 10 lakh 50,000 rupees, right? So one would easily say that uh, 10 lakh rupees at the end of 1 year is not equivalent to 10 lakh rupees as of today. And if someone applies ratio and proportion of this 105 equivalent to 10 lakhs, and if the 10 lakhs divided by 105 and multiplied by 100, one would get the value of 10 lakhs as of today. This simple calculation is called as determining present value of future cash inflows. So to determine value of cash inflows which are accruing over a period of over the different period, over the life of that data, that needs to be brought into the present value, so that all that can be comparable. Similarly, as we just discussed, today's 10 lakh is not equivalent to 10 lakhs of year one end. Similarly, it will not be equivalent to 10 lakhs of year two, and 10 lakhs of year two end will not be equal to 10 lakh of year one end. So if one is comparing 10 lakhs at today's point and 10 lakh at the end of year one, that will be like comparing apple to oranges. If someone has to compare apple with apple, they had to be equated on a same level. Either each and every value needs to be brought on today's date. So need to understand what is the value of 10 lakhs after 1 year as of today. If we apply, if we divide by 10 lakhs by 105 and multiply it by 100, it will give around 9 lakh 5,000, 9 lakh 50,000 or 9 lakh 55,000. So this 9 lakh 55,000 as of today is equivalent to 10 lakhs after 1 year. So in our example, we just discussed, if some data is giving me regular cash flows in regular intervals during different years, to compare it or to sum it up, we need to bring it to a common base. As Namit ji rightly pointed out, continuous compounding. So this is not continuous compounding. Compounding would be carrying 10 lakhs today to future value. That is called compounding, carrying it to future, and bringing it to today's date is called discounting. So the cash flows accruing out of the data, cash flows accruing out of any intangible asset or any asset needs to be discounted to today's present value at an appropriate discount rate. Mahindra Limejin, you mentioned how you will evaluate data in case of theft of data. Original data is with you, your organization, but someone has copied it. Now asset is with you, but it is copied. How it can be handled? So I'll come on to this. Let me complete this phrase of valuation under income approach. So if a data needs to be valued, one needs to estimate how much cash inflow that data will generate over the period of years, and one needs to, the valuer also needs to ascertain an appropriate suitable discounting rate which should be applied, which should be, in our case we considered it as 5%, but that can be different for different companies or different situations or different assets. That discounting rate needs to be calculated, needs to be identified, and using that discounting rate, those cash flows needs to be discounted as of today's rate, and all those cash flows pertaining to all those different years, the present value of it needs to be added up, summed up, and that will be termed as value of that data. Now, in the income approach, as you would have pointed out, there are two aspects to it. One is the cash flow that is being generated out of data. Another is the discounting rate. So as you can see, there is subjectiveness involved in both of these two factors, which are primarily being used to determine the value of the data. One is cash flow. The cash flow projections can be different for different persons, different organizations, and different perceptions. And the discounting rate that is being determined, that can be different for different people. So coming on to discounting rate part, how discounting rate is determined. Discounting rate is nothing but the expectations out of the asset. As we just discussed, 10 lakhs when one is putting in the bank's FD and getting 5%. That 5% is the implied expectation of that person from the 10 lakhs. But this 5% expectation will increase if, let's say, coming on to that deal, if now I say you give me 10 lakhs, I'll give you 5%. I'll give you at the end of the year 10 lakh 50,000. Would you be ready to give that 10 lakhs to me? I believe the answer should be no. Simply because if I am also giving you 5% return and bank is also giving you 5% return, bank is more reliable. You have less risk with banks compared to me, because with me you don't have any fundamental backup as compared to banks, right? So you would say no, I'll still not come to you and I'll go to bank. Then what should I have to do? Naturally, to compensate that additional risk, I'll have to give you additional return. I'll say okay, I'll give you 7%, I'll give you 10%, and at a particular rate with which you are okay that yeah, 10% seems fine, you will be giving to me that 10 lakhs. If I give you return at 10%, that 10% is the expected rate of return out of that 10 lakhs. We just arrived at this 10% number by hypothetically discussing a case. This expectation can be different for n number of people. Now naturally there will be and with data, to put a value, someone would be expecting that with this data I'll be earning a return at 10%. Someone will be expecting that I'll be earning return at 12%, 15%. Those n number of people will have n number of judgments. So how would one arrive at that discounting rate, that expected rate of return out of that underlying asset? It is done with statistical techniques. Basically, the data, the company in which, so it has many multiple elements to it. One is, as we just discussed, there is a risk-free rate. Anyone would be expecting a return over and above the risk-free rate. In India, if someone wants to ascertain what is the risk-free rate of return, and when I say risk-free, it simply means that if I put an investment with a particular entity or with particular person, my asset will not get affected. I'll definitely be ensured to get return my principal as well as my interest. That is the risk-free rate. And in India, who can assure you the risk-free rates? You would say banks, but be mindful that banks also can are there is a little risk that they can also go bankrupt. So ideally, conceptually, the asset and the return should be risk free. To put a proxy onto it, government is a good proxy of saying that the asset is risk free. If you put your assets in government bonds, for in 5-year government bond, in 10-year government bond, you would feel assured that yes, I'll get my principal and my interest back. So that return from the government, that rate of return from the government can be considered as a good proxy of risk-free rate. But as we just discussed, no one would accept a risk-free rate of return from a risky person. So an appropriate risk premium is added to that risk-free rate to determine an appropriate discounting rate to discount the cash flows accruing or arising out of the underlying asset, which is in our case data. This market premium is determined by comparing this data asset or the company's asset with comparable companies, what returns they are providing to their investors. Simply speaking, let's say if you have a replicable asset, let's say the type of returns that you are earning out of this data, you can earn that out of Reliance. So if over the period of 10 years, Reliance is able to provide you 15% of returns, then and if the market rate is if the risk premium if the risk free rate is, let's say, 6%, which is offered by the government, you will safely say that 9% is the risk premium which you would be expecting out of this data. And now the cash inflows arising out of this data would be discounted at 15%. And after discounting all those cash flows to today's present value, one will sum it up and determine that this is the value of my data. This is how normally data valuation under income approach is done. There are multiple methods under income approach. The the basic fundamental to income approach is this only, that the cash flows are discounted, the cash flows that are arising on in different period and are discounted at a appropriate discounting rate so that one can arrive at its fair value. The different methods of valuation under income approach, as you can see, are relief from royalty method, multi-period excess earning, discounted cash flow, and with or without method. I'll discuss each and every method under income approach. But each and when I'm saying that there are these three methods and these three approaches of valuation, wherein there are multiple methods to value, please note that this is not an option available to valuer to pick any approach and pick any method to value the underlying asset. The conditions of the asset, the underlying environment in which that asset, that data is prevailing, is providing returns, considering that different approaches are determined. So for example, if I am having some internally accrued data for which it is very new, hardly 1 month has passed by, and I'm unable to understand what incremental effect this data will have on my cash flows. So in a way, we are saying that this incremental cash flow, this data, we are not able to understand if it will be able to generate any cash flow or not. So since we are not able to identify any cash flows, we cannot apply income approach onto it. And we have to then switch to either market approach or cost approach, whichever is suitable to it. Similarly, the multiple methods which are available under income approach all those are not available to be used as an alternative. Rather, an appropriate approach needs appropriate method needs to be picked to value the underlying asset. The four methods which are available under income approach are relief from royalty, multi-period, discount cash flow, and with or without method. What is relief from royalty method? Relief from royalty, as the name suggests, is if someone is having that data internally, in absence of that data, what amount of royalty it would be having to pay to an outsider to get that data. That royalty payment is saved, that cost, that cash outflow is saved by having that asset with me. So identifying over the course of period what royalty I would have been paying to the third party, that would be my cash inflow, that would be my cash savings, and that needs to be discounted over the period to arrive at its value. But it might happen that the kind of data that I'm having, that is not available for leasing by third parties. It's very confidential and no one gives it to me. So in this case, relief from royalty method will not be applicable to us. Similarly, and the data, since it's confidential, no one directly leases it out to any entity. And since we are kind of discussing to a data which is internally generated, internally accrued, and what would be what is the value of that data, and what would happen if that data gets lost, or gets stolen, or gets shared with anyone, gets compromised with anyone, we need to value that. We need to understand the impact of that. So for that purpose, the third and fourth method is only the one which can be useful for us. The second method is multi-period excess earning. This method, what does it do is, we value the entire company or the entire entity, and after determining the value of entire entity, we determine what is the value or what is the return that is being given by the intangible assets or the other assets, such as land, building, machineries, etc. And so basically determining the rate of return of each and every other assets other than data, and that total value is subtracted from the total value of the company. But again, this method is not useful for them, or cannot be applied where one does not have that internal that rate of return of each and every asset. And this method is actually very difficult or very impractical to be applied in practical sense. Since as I said earlier, the third and the fourth method, discounted cash flow method and with or without method, these two are the most prevalent methods which are used to value data. Um, I just read messages of Mahendra sir. Now I would like to link it to the current point which I'm going to elaborate. What if data is stolen, or in case of theft, how would one value data? So, in the discounted cash flow method, if one is able to identify what would be the inflows directly attributable to my data, then one can directly apply the discounted cash flow method, which we just discussed in detail. That one has to ascertain all the cash inflows related to data and discount it at the appropriate rates and arrive at the total value of that data. But as you said, what if data gets stolen, or data is compromised with another entity? If that data is compromised, uh, then you can determine the value of that data by the fourth method, with or without method. It's just like that. If one has that data with you and no one else, what will be your total cash inflows each year for the coming years? And if your data is compromised, then what will be the effect on your total cash inflows if data is compromised? Let's say if you only have the data, you have a separate edge. If market in the market your competitors are able to sell the products with a profit of 10 lakhs per year, you are able to do it at 20 lakhs per year. Then that additional 10 lakh is the incremental cash inflow that is arising out of the data. But if data is stolen and you know that there are competitors in the market which can use this data and hamper your competition, hamper your monopoly, and because of which now others are also having the grab out of it, and your market share of sales is reduced, and compared to it, now you are only able to make sales of 15 lakhs instead of 20 lakhs. Then this decrease of 5 lakhs per year is the value that you have foregone. If we discounted it to present value and sum it up, then that is the value of data that one has foregone. This is generally called with or without method, that with that data how much you are able to generate revenue, based on that what is your cash inflows, based on that what is your total value of the company, and similar calculation, similar scenario is painted out without that data. What is your total revenue without that data, what is your ultimate cash inflows without that data, and then based on that what is the total value of those cash inflows. The difference between the two is simply the value of data, because of which you are making this incremental cash inflows over different period. This is how value as per income approach is determined or assigned to a particular asset. And as I said, this is the reason I told you that income approach is the real authentic approach to value a particular data, and not market approach and cost approach. What we do in market approaches, now switching to market approach, that we identify comparable assets or comparable transactions or comparable data which are selling in the market at an arm's length distance between two arm's length parties, between two independent unrelated parties. In the market approach, what does one do is they see that the data which is available with us, the database which is available with us, if that has been purchased or sold in the market by two independent parties, and if that has been done, those transactions are compared to our data, that underlying asset is compared to our data, suitable adjustments are done to our asset to arrive at our value. But as you can see, this is just price, the price that two independent people have arrived at, have discussed and agreed upon, that we will decide that this is the price. This is just a proxy for valuation, and it is not an actual valuation of that data. The actual value can be different because the cash inflows that can be generated out of that data can be completely different. Maybe the one paying that price, or maybe the one receiving that price, would be okay with that, but it can happen that the underlying value, underlying uh, cash inflows that can be generated out of that can be much less or much more. So comparatively, market approach is not a valuation technique, and rather it's a pricing technique. It's just prices which are available in the market, and one arrives at the most comparable transaction and allocates or compares that price to our data, and that price is agreed upon to be the value of that data. This is how market approach works. So Mahendraji, I hope your query is resolved, that how original data is with your organization, but someone has copied it, will affect our data and our data's value.
Sure, sure. There is another query from Namit.
Yes.
Because we have another 5 to 10 minutes left. So just
Yeah, I'll run it through quickly. Some companies exist as API companies. Their entire asset base is an algorithm coded as an API. If that algorithm is stolen or leaked, how is the loss computed? Sir, Namitji, simply speaking, if we put this question in what we just discussed, the company which is using their entire base is that entire asset base is that algorithm. If that algorithm is stolen, what could happen in the market is their revenue will drop, or their will revenue will cease to exist. or they have to compromise with their selling prices. They have to bring their selling price or subscription price down to what with which they can sustain in the market. So applying the with or without method, without that data being stolen, what was the value that the company was achieving by discounting the cash flows, and what is the value with that data being stolen by reducing the estimated revenues, the estimated selling price, the ultimate estimated value, and the difference between the two, that with that data stolen, how much value has been reduced, that will be the amount of loss of that is caused due to that algorithm is being leaked or stolen. Does that clear your query, Namit ji? Okay. Now we have covered market approach and income approach. Now coming on to the last approach, which is cost approach. As I earlier said, cost approach again is not a valuation technique. When someone is not able to project the cash flows or identify the cash flows that is being arising out of that data, or when if in absence of cash flows, if someone is not because the in the market approach, it is not easy to identify the comparable transactions. It is first of all very costly. One has to have access to the database, and one has to have hold of the techniques to adjust the differences between the two data, one the comparable transaction and one is ours. And that might not be possible because the dynamics are such that the two data are not that the two assets cannot be compared. So in the absence of cash flows and in the absence of comparable, what one can do is go to the cost approach. And cost approach is nothing but simply determining how much cost will I have to incur in order to replace the data which I have been missing, or which I have, if I have to create that data again, I have to reproduce that data, what amount of cost that I will be incurring, that amount of cost with suitable adjustments of depreciation or redundancy or obsolescence of data, that with that adjustment one can arrive at the amount of cost, and that again being the proxy of value of that data. This is how under cost approach one values data or any asset. As you can see, there are two methods: replacement cost approach and reproduction cost approach. These two methods are not at the mercy of the valuer to be used. For different assets, some assets can be replaced, that are they are readily available in the market. One can, for example, if subscription has been stolen, if we have subscribed to particular database, that subscription has been corrupted, so one can just go and resubscribe, replace that cost. That if that can be done, one has to choose the replacement cost approach. If there is no replacement available, then if someone has to reproduce that data from the scratch, how much cost it will incur, that will be the value, that will be the cost under the reproduction cost approach, and that will be the proxy to the value of the data. With this, I have tried to briefly cover the methods by which valuations of data is done. If you have any other queries, or if any queries have been unanswered, please let me know. I'll be happy to resolve those queries.
Milan, overall session was very fine. Our main idea to have your approach in this particular data protection or FDPPI is there is a concept which is known as in coming laws, there will be impact assessment if data is breached. what could be the harm, or harm audit is the concept which is covered under upcoming Data Protection Act. So in that perspective, we are looking as a valuation of data, how data can be evaluated, or the question was framed to harm analysis. What harm could be caused to an organization if data is stolen or misused by that particular organization? So we just understood by your presentation what are the different techniques of evaluation of data, or how valuation can be done regarding assets, and you wonderfully tried to correlate it with data valuation. But in my views, data valuation or data evaluation is emerging stream, and there are yet not some or good guidelines to how data can be evaluated. But yes, your insight to evaluation certainly helped most of the participants to explore new visions about how data can be evaluated and what concepts could be applied to valuation of data. If any other participants has any comments or queries, they should go ahead. And before ending the session, I'll thank you for your nice interactive session. And with this short notice, you prepared wonderfully and gave wonderful insight of valuation. So there will be questions, but I am just thanking you before, because there may be end to this particular session prior to my intervention for proposing vote of thanks. So I have in advance proposed this vote of thanks to you. We are thankful to you for your presentation. Now, anyone if has any questions, please go ahead.
Yes, sir. Milan, I have one question.
Yes.
Uh, see, supposing you have succeeded in putting data on the balance sheet, you may also have to need periodically impairment testing.
So supposedly, if I am able to put the value of
And
data in
also,
the balance sheet,
besides impairment, would you also foresee a requirement where you would have to amortize that asset over its lifetime? Any amortization requirement will also be there? And
no,
how about impairment?
no. First of all, the amortization and the impairment analysis is done if the asset is allowed to be recognized in the books. So I believe it is presumed that the data as an asset is allowed to be recognized in the books of accounts.
Yeah, assuming it is, yeah.
Yeah. So okay, then you are right. Amortization is basically a function of reduction in value of the underlying asset, in our case being data, over the course of its useful life. Okay. Now, in with the wake of India's, which is basically promoting accounting by virtue of fair value rather than being at the historical cost, there are two methods or two approaches to amortize the asset. Earlier, under the historical cost approach, under the old accounting standards, the value of the asset, I cannot say the cost of the asset because there is no cost in our case. So the value of the asset is amortized over the period of its useful life. Let's say if the data has a useful life of an effective useful life of 5 years. So the amortization of the value needs to happen over the period of 5 years. Um, this is under old AS
Yeah,
accounting.
see, yeah, sorry to interrupt, but see here, data will present some unique issues here. For example, let us say data under the privacy laws, you have to obtain under some consent with the data subjects, right? And that consent may have to be renewed periodically, right?
Right.
Okay, so it is not that there will be some data retention period that you will claim, right? And
Right.
you may at most you may have to be able to maintain the data for the period for which this has been disclosed as per a retention policy, right?
Okay.
Now, so one will have to keep continually assessing those aspects also in determining the total useful life. This is all assuming that you have succeeded to bring the data as an asset onto your balance sheet. Okay.
Right. So
Right.
that's why this was the challenge in old accounting standard. It was quite plain and vanilla that if the value is 5 lakhs and its estimated useful life, considering all the contractual obligations and its usefulness, the effective useful life is 5 years. You just amortize it over the period of 5 years, 1 lakh each year. But with the wake of India's the fair valuation accounting concept, one amortize it based upon the fair value at the end of each year, depending upon the circumstances available at the end of each year. The
Right.
fair value which has been recognized as an asset is
Mm.
amortized in
Okay.
today's date. Sorry.
No, got it. Got it. Continue.
Yeah,
Yeah.
so different situations or different circumstances are existing on at the end of the year. Accordingly, the amortization value, the actual value which is being amortized, actual value which has been used up, is written off, is amortized in the books of account. And likely, similarly, impairment analysis, the asset as a whole, how much it is valuing at a particular date, depending upon its usefulness at different period, because of the wake of different events. Let's say that data is no more allowed to be used by the government, entire asset becomes useless, so entire asset would have to be impaired in the books of accounts. This is
Yeah.
applicable in old AS as well as in new Ind AS as well.
Yeah. So these could be additional issues that one has to look into, because so far what you covered is what is the value at which it should appear in the balance sheet. Assuming
No,
that one has decided and one has solved that problem, after it will come into the balance sheet, there will be additional issues that need to be taken care of, right? Like,
but sincerely speaking, practically, such assets are not allowed to be recognized in the books,
actually,
which are
in a limited way, even today, data uh, does come onto the balance sheets. For example, when an M&A happens, right? In the list of intangible assets, for example, customer lists, right? These kind of things are do come onto the balance sheet of company. They are allowed to come onto the balance sheet
right.
in a limited way. It does come in, right?
No, it is practically happening.
Yeah,
If this is the case, this is practically happening. I can elaborate on this.
yeah.
That in an M&A, a
Hmm.
seller will sell its company to a buyer. Okay.
Right,
Now,
right,
the for the seller in its books, there will not be this asset existing. But for the buyer, if the asset, as per the books, it's valued at 100 and the buyer is paying 130, and under the merger and acquisition agreement, by the virtue of the scheme of amalgamation and arrangement, which is submitted with the NCLT code, they clearly recognize that additional asset, which is being goodwill, data, as a separate asset. And since
right.
they are in 30 extra over and above, that there is clear purchase of those intangible assets.
Correct.
So the purchaser can clearly, by virtue of the scheme of amalgamation, which is accepted by the NCLT,
Hmm.
book in their books of accounts the asset of data at 20, because they have actually paid for it, and it is allowed in today's accounting standard, either old AS or Ind AS. And if that 20 is recognized in the books of accounts, after at the end of each year, its value is determined based upon the valuation principles we just discussed, that what is the value existing as on the date of end of the year. If compared to 20, the asset value has been dropped to 16, the 4, the amount, the difference of 4 will be amortized in the books of accounts. And impairment testing will be done, likely, let's say if during the year suddenly that data is not allowed to be used by the government policies are being changing, and they have brought in stricter guidelines that, look, these are the personal data, you cannot use this, and that is breaching of freedom of right to privacy under the constitution of regular people. You cannot use it. So since it is legally prohibited to use that, they have to write off that entire asset of 16 or 20, as the case may be, in their books of account. So the money they had paid to acquire that asset under the amalgamation, under the merger, in the deal, they have to write it off, uh, percent to impairment. So this was not the case where the asset has been internally generated and accounted in the books, because if someone has internally generated and accounted for in the books, the accounting entry
So
will
that is
be
not allowed. That is not allowed under the current laws, right?
right,
That's not allowed in the
because
current
that
laws.
will inflate its equity and profits by a notional number, by a number which has just arrived internally. Asset account debit being database to capital reserve account to profit account. That is not allowed, because that will just disturb the profits reflecting in the books and disturb the comparability or reliability of the financial statements.
Yeah. Okay. Thank you.
Namitji, you mentioned that based on this net4 case, should value the domain name and services too. So again, coming on to this, if the seller is selling out its business, let's say, if let's assume Google is selling out its business to Amazon or Apple, so the domain name Google, it's so much valuable because multiple searches will invariably happen on Google, and with the search on Google and with the search on Google and the hitting of link via search through Google, the Google business will generate revenue, because so the Google domain name is so powerful, it can definitely value that domain name, that data, again by this methodology only, that without that Google domain name, how much revenue the entity could have generated, and with that domain name, how could how much revenue it could have generated, and that excess revenue, its present value, will be the value of that domain name, which can be sold on to the buying entity. But Google by itself cannot recognize the domain name Google as its asset. I hope I answered to your question, Namitji.
Yeah, I hope if there are no any other questions, we will thank again Milan for his wonderful session, and see you, Milan, again with different topic. Hope the questions were also have some sort of idea to you how we at FDPPI think about data and what approach we want to understand from CA. So thanks once again. And just a small reminder, next Wednesday being Republican Day, we will not be having our Dhanavardhini. So on 2nd, we have special session for Dhanavardhini. So hope we again join after 26th, that is, I think, 2nd of February for next Dhanavardhini session. Thank you, Milan. Thank you all
Thank you,
participants for
Mahendraji.
joining this session.
I mean, thank you very much for this opportunity. I will like to express my gratitude to you and FDPPI to give me this platform. I hope I was able to meet the expectation and serve the purpose. You mentioned, Mahendraji, that there can be data theft and how could the value be assigned to it. Practically speaking, we do the valuation in this manner only because it represents the value that someone has foregone by data theft. In case of any further queries, one can contact me on my email ID or my phone number. I'll be happy to resolve those queries or give further inputs. But yeah, thanks a lot for this platform and truly feeling gratitude towards this entity and BPI for this noble idea of sharing the thoughts every Wednesday. Thanks a lot.
Thank you. Thank you all.
Thanks everyone. Bye bye.